Hey, everybody, happy Thursday. Welcome back to the final hour. It's just after 3 o'clock on the 19th. We are one day away from our final full week of trading completing. To say that the market disappointed this week depends on who you ask. Certainly, we had some downside movement. It was all taken in yesterday, but it certainly felt a lot different and one would say better than August 5th when it happened over a weekend and the futures market went crazy on Sunday going into that Monday morning and we gapped lower and the futures market was pretty much illiquid. So it didn't feel like that. Global markets did a pretty good job of containing the sell-off yesterday. We also have I think I have a triple witching or maybe more. Let me see if December 20th options expiration. It might be quadruple witching. Let's see here. Third Friday. Where are we going at here? All in one. No. All right. Anyway, is December 20th triple witching. December 20th is not triple witching. It occurs the third Friday of March, June, September, and December. So it says it's not. So was it more? Understanding witching hours and December. So it's the third Friday of March, June. Do we have one, two? It is the third Friday of December. What's this talking about? Contracts are not closed by expiration. They could have to buy or sell the underlying security. Witching hour, triple, quadruple witching. All right. 3 or 4 of the following. So stock index futures, stock options, single stock options, and stock index futures. Yeah, so that's triple and quadruple witching days, which I'm pretty sure is tomorrow. And the concentration of expiration of contracts, these dates can catalyze higher market volatility and heavy trading volumes. So I almost wonder if a lot of the stuff going on in the background was what accelerated the move yesterday with the Fed. I mean, look, the market reacted within the first 5 or 10 minutes of the 2 p.m. rate cut. So, I mean, the fact that we had like full on follow through, I mean, I was dumb enough to, take a trade here and just say like, well, if we're going to bounce and, I lost like 40 cents or 45 cents a contract, which was fine. I did it for a Friday expiration, which is tomorrow. I end up closing out for a small loss on it. I think I end up losing like 36 cents profit or 36 cents per contract. And then another one that was like 32 cents per contract or something along those lines. So managed risk. I took a stab at it. It was silly, probably unnecessary. The trades that are paying out really nicely are the hedges that I put in for the last 30 to 60 days. I'll be watching those closely. I put in a trade today on my Pulver alerts. It's in the Discord channel for A1 Trading. I put a trade on Visa and MasterCard. So V and MA, I looked at both of them. I'm looking at a bear put spread. They're pending right now. They're not filled, so they're still working orders. But I'm looking to see if we come back to these highs, if I can fade those highs a little bit. I don't know. I just think if we have a bit more of a push to the downside. I mean, here's the S&P right now. So our SPY has one nasty day from Wednesday. Today we're sitting here near the lows. I don't really know. I mean, tomorrow having it be, quadruple witching, plus we have PCE tomorrow morning at 8:30 a.m. Eastern time. So here's the Bloomberg calendar. I've been waiting on these forecasts all week, and we finally have them. I talked about them this morning in my live sessions. This 8:30 group of news. I'll take out the CAD retail sales, but this for U.S. news. The core PC price index was a previous at 2.8, forecast at 2.9. That's right alongside what I read from the Fed websites this last week. The PC price index year over year, 2.5, previous 2.3. So again, this is supposed to be the Fed's desired inflation reading. And, I'd say Jerome Powell kind of barked back a little bit by, yes, I know the Fed cut, but there probably was, in his own cryptic way, ways to basically say like the Fed is looking to be restrictive, needing to be restrictive, wanting to be restrictive in 2025. And, even when somebody's asked, like, would there be rate hikes on the table or is anything off the table? And he's like, well, you can't rule anything out and blah, blah, blah. Like, it was an interesting FOMC. I mean, I listened to it past 3 p.m. The Q&A went longer than usual. It wasn't as scripted like it usually is. He went off on tangents on tariffs. He spent a lot of time talking about inflation and how it was higher. and mentioning that they're forecasting inflation at 2.1 is not going to be seen. It's like they're forecasting 2.5 now for the end of year 2025, which is progress, but it's not 2%. And right now, having several prints that are showing maybe we're closer to 3%, and the Fed's all the way down to 4.5 or 4.25, that just puts us back where basically the Fed's like, we need to, stop the market melt up and really try to put a pin in inflation and at least keep it from going second wave higher. Like, don't let it run ridiculously high. And here's Trueflation, just to get a reading on it. So let's see if there's any reaction here. So this is our big pivot from the Fed when they cut rates. And I don't know why that shows. It should have been like 1. It was like 1.01, I swear. Now it shows 1.68. I could have swore this was a 1.01 reading and it was like 2 and change. Anyway, it doesn't matter. 1.68 showing the bottom here in September. That was right before the Fed rate cut. And then they cut in September by 50 basis points. They cut again November. They cut again yesterday. And the market reaction wasn't negative until yesterday. And so I feel like all the melt up, even the post-election gains, the Dow gave back pretty much the post-election gains. Look at the election gap in here. I mean, if the market's interested in trying to find some support, this is the spot to do it. So do we come back into the same level? Do we potentially fill the election gap where we come all the way back down to this candle? Perhaps we get to 580 or 575. I would think it'd be important to see the bull market stay structurally sound by not taking out these lows. Okay. If we end up taking out, I mean, this could be, somebody could say like, oh, there's a head and shoulders and there's a topping pattern. I mean, maybe it is. But I think there's more damage done if this comes all the way back down here to take out that lower, challenge that low. That to me is, where the dead cat bounce and the real correction takes place. Because the one thing we didn't see is, you notice how we had like high, low, lower, high, lower, low, right? Back in August, we had high, low, lower, low in April. What if we have a high, low, okay? And if this falls a little bit more through the holidays, we have a fake or false rip early 2025, and then more pressure to let this thing complete or fill this corrective move. So I would be prepared for something like that. I think a high low, and we don't know where this low is going to be established. But if we have like a one-off day like Wednesday, and then the market just kind of chops around here through the next 2 weeks of light holiday trading, maybe that's our bounce. Maybe that's our 1, 2. Let me just highlight that. So maybe if it goes sideways here, that's 1, 2, and then 3 is still coming. And we have more pressure that mounts to get us back to the 200 moving average. We've got about 290 bars from the 200 EMA. It still hasn't been hit. I found that this morning on Netflix as well as Meta and NVIDIA. Actually, no, not Netflix is like 290 bars, but the big bar counts NVIDIA and Meta. Let me see. Actually, I wonder. Fudge. Let me see something here. 200 EMA bar count. Can I do a bar count thing? Bar count for back testing, bar count, bar counter, custom bar counter, trend reversal strategy. See what this one looks like. Upper channel, lower channel, properties, inputs, number of rises, number of falls. This isn't what I want. I was trying to put it based on an indicator, so I'll just delete that one. I know there's a way to do that. I don't know if anybody has this indicator. Bar count. I mean, I can obviously make it. Green, red, bar count, longest sequence, candle, price filtering, moving average. Nope. All right. I don't know. I can probably just code it, honestly. I don't know. We want to have some fun today. We'll do top down. Let me bring up some Copilot. Copilot was pretty cool. I built some charts and workspaces last weekend using Copilot. It was pretty simple. Build me a bar count indicator on TradingView, showing me how many bars it has been since price hit the 200 exponential moving average. So let me see what this looks like. Okay, I'm going to open up a new workspace. So let's go for fun, create new layout, and I'll do bar count, new tab. What are my highlights here? Oh, cool. I've been with TradingView for almost 4,000 days. Continue the journey. Yay. All right. All right. All right. Cool. Cool. All right. Anyway, let's get out of here. Give me a new workspace, would you? Let me catch up with the comments here. So, Heather, yep, quad is tomorrow. Thank you for letting me know. Sarah says, Powell purposely said what he said. That's not true. I mean, come on, man. You can't say that. For what reason? Did he use his FOMC platform to show his distaste in Donald Trump? I mean, come on. Like, it was definitely a speech that was uncharacteristic of Powell. But either way, does it matter? Are you going to blame Jerome Powell and say, like, Jerome Powell, I lost all this money because of you yesterday? That's the market, man. That's trading. So that's just an answer and explanation that somebody you'd have to like grasp onto and say it's all Powell's fault. It's like, look, the market has been showing us signs of narrow concentration, overstretched conditions, incredibly high frothy sentiment with risk appetite so pinned to one side, it needed to be rattled. It needed to be contrarian. So I don't care what Powell said yesterday. If he kept his mouth shut, would it have still, maybe it wouldn't have been FOMC, but maybe triple witching or quadruple witching tomorrow with PCE would have been the same type of move. It's like, I think it was coming whether you wanted it or not, right? So there's no blame. It's like you trade and you trade and you deal with the markets and you take the punches and you roll with them and you survive and you just keep trading. So it's not Powell's fault. He was, like I said, it was an uncharacteristic speech. Whether it was a political play, it's like, look, the guy's the Fed chair going into the new administration anyway. So, I mean, is it career suicide to do something that was intentional and malicious? I mean, maybe, but I don't think he can get fired. So who cares? I just think he said things that were not scripted. He went into tariffs, which I don't think were expected. He spent a lot more time on inflation, which I was surprised he did, because that has been like the underlying sticking point where it's like, I see this, we talk about this, we see this, like the Fed has to be noticing this crap. And yeah, they do. I mean, yeah, inflation's high and they recognize it. And their projections are not great. And the Fed is all of a sudden going into like neutral mode again. They're not going to cut, and if they're not expected to cut until like March or I'm sorry, like May or June or July, that's a lot of months where all these gains could have to prove that they were justified. And if they're not justified and we have a weaker, Q1 earnings print for all these companies, their expectations are super low and they still disappoint. It just shows slower growth, higher inflation. All you're going to read about is stagflation, and the market's probably going to take, another leg lower. So to me, I think that this push down was significant enough that we either have, lighter trading through the holidays, that maybe this just drifts a little bit lower, but there's not a ton of volume there. It won't necessarily get more accelerated, I don't think. Or it was a one-off move, and then the market just spends some time kind of grinding back where it started, and it gets back to this point, and then we have another flush lower coming when the volume returns in early January or mid-January, right? But I would at least expect some type of high, low, lower, high, lower, low move. And, for this point, it's like, what's next? Either we have another low that's still coming for like a little flush lower, or we have the one-off move, the little correction, another sell-off. We match some symmetry, try to find some levels, get interested in where this thing could show some potential technical lows, and then we start looking to get excited about reinvesting or, getting our positions back established there, right? So we'll see. All right, we'll see what happens. All right, anyway, let me open up a new workspace. I'm going to see if this thing will actually show up. So new layout, bar count, there. And let me plot in this Pine editor. Get out of here. This is I already have this one saved. I'm going to delete this one. This is one that I built last week. So let me get rid of this. And I'm going to try to save this one and see what it does. Okay, so let's add a chart. What is this crap? All right, this is what happens. I build it, and then I've got to add all these extra iterations to it. But I'm looking at a bar count, 200 EMA. Let me add something here. Let's see, display a histogram showing a number. That's not right. Get rid of volume here. The script will display a histogram showing the number of bars since the last price last crossed the 200 EMA. Let me know if you need adjustments. Well, I don't see a histogram. I think you crazy. So bar counts. Okay. Visibility. Okay. Where's my histogram? Is it on the... Well, I see that it's got the right count, 284 bars, but I'm not seeing the visuals of my histogram. Anyway, I'll fudge around with it. I'll build this out. We'll talk about it later. But what I'm looking for is if I spot check some of these stocks, I go back to this workspace here. This red line is my 200 moving average. I've used this for years. It's a nice sign. There's two moving averages I've used over the years: a 200 moving average and an 800, and those are way out there. But an 800 on bigger time frames tends to be this weird, big, significant dynamic support, dynamic resistance on daily and weekly charts. The 200 also is kind of your industry standard, buy zone above the 200, sell zone below the 200. It's always been a pretty good measure of dynamic support in a bull trend, dynamic resistance in a bear trend. You can take this all the way down to a 1 minute time frame. You can take this all the way up to a daily time frame, weekly time frame. It works. Okay. So anyway, I've been watching these dynamic levels for a while. Our bar count is relatively high, like I just showed there, 284 bars on the SPY. Let's do this. There's my RSP. All right, that is an ugly histogram. I don't want that at all. So that's what it looks like. I obviously don't want that. SPY, that's better. Still don't love that. I'd rather just give me the visual. So anyway, I'm going to play around with that code. That looks stupid. Just like that, I hate on AI. Anyway, but I certainly don't know how to code it myself, so it's at least a starting point. And that is the reality of AI. Use it to be more productive. Have some conversations with your Chat GPT or your Copilot or your Google Bard or whatever they are now. I don't know. Have some fun with it. But it does take a little bit of patience. And I tried to build out a spreadsheet to give me these real-time alerts and put in some webhooks, and it's gets a little complicated. Anyway, what am I talking about? Who cares? All right, so bar counts, there we go. RSP, same thing. This one's coming back into the 200 moving average, which also has not tested the 200 moving average since November 2023. This might be a spot that I might toss in a few more. That is about 277 bars right now. Is this a guaranteed level to be buying? Probably not. Going back to the August lows, I would say, look, if I'm interested in equal weighted, I think buying this would be pretty nice. That'd be level 2 for me. And then level 3 would be the August lows. So if I have level 2 and level 3, if all I did was put in $1,000 and $1,000 and $1,000, I'm good with that, right? That would give me a nice healthy discount. Let's say that I get all the way back to the August 5th bottom and I dollar cost average in 3 times and we're down 14%. Well, it could get worse, right? Could I double that? Yeah, sure, maybe. And so maybe for me, it's I just wait for this level to be hit and see if we end up having a move back up. I guess my biggest concern with what's been selling off aggressively, like the equal weighted S&P and like the Dow, like the Dow's been selling off really aggressively. It's had the worst losing streak since 1974, which is a 50-year run. This might be the 1 and then a 2 and then a 3. So maybe I need to hold off on buying here unless it's short-term, last in, first out type stuff where I can close out whatever I want. But I'd be prepared for maybe a deeper discount to kind of establish a core position and then work my way through it that way. Okay. So could we come back into previous all-time highs at 165? Could we come back into this structure on equal weighted here? Sure. What kind of discount do we get? Well, if all it is a, low to high, like I don't know how much this market's going to correct, but we are sitting here still pretty much, in a buy zone based on the moving averages. But we did, based on this equal weight, take out this recent swing low. So if we take out the swing low, is this high to low, lower high to lower low? Is it a fifth wave move against this? I don't know. Because if this is wave 1, 2, 3, 4, 5, we'd at least expect to see an ABC correction. Okay. So an ABC correction would be something like this that challenges this area. It's either the, fourth wave pullback or it's the third wave high. So if I'm buying equal weighted, which I would put more into my portfolio, I'm just looking to see what are my better prices to get in. Okay, let's go to NDX. This one, during the August 5th bottom, the NASDAQ did hit the 200 moving average. Okay, we do have some dynamic levels. I would still look to see, I'm not ready. I don't know. This technical stuff could be a little awkward. But if I have like this low, let me do this here. So if we went from low to low like that and high to high like that, is that some structure that ends up behaving? Maybe, right? We come back down towards these, 200 moving averages. We establish some bottoms in here, and then maybe work our way back up and we try to grind out all-time highs, but it's going to be a grind. Think about what this market did back in 2018. We had a vol event in January. Look at what 2018 trading was like. It was not fun. I don't know if anybody remembers it, but I do. 2018 was kind of nuts. Look at what this did. We had this big vol event like end of the year in 2018. So that was a January, 2018 giant drop, and it all kind of initiated like right in the beginning of the year with that vol event. And so we went aggressively lower, found a way to get all the way back to the highs again, went aggressively lower again, found a way to spend the entire year from April to literally September, October, spent the entire year just grinding slowly all the way back up towards all-time highs again, but we gave a lot of that back. And this was what probably a lot of investors thought was extremely disruptive because we took out major lows. We had a bigger swing this way, right? And so in the year, it's like this was a crazy year. This was a crazy year. This melt up was January into end of January. So we had like one melt up at the beginning of the year, and then we just tanked. And then we spent February to March melting up again, and then we dropped. It's a lot of volatility to have like all-time high swing, plop. All-time high swing, plop. Right? What's that pullback? Those are like 10% pullbacks. That's a 12% pullback high to low. This one is about the same, about 12.5% high to low. Okay, and then it got a little nastier when we had a 20+% drop when you go from high to low. There's a 23% pullback, and that was from September into I think the next year's January. Nope, that actually finished. Lows was it was pretty much Christmas. Wow. So September to December, pretty nasty spill in the market for 23-24%. So, yeah, I don't know. The market's going to do all sorts of wild and crazy stuff. Nobody knows. Here's where we're at right now. Market still found a way to grind through all that stuff, give us highs and give us lows and give us pullbacks. You just got to keep trading, And so I think there's room to fall. I think there's room to try to hopefully find some better levels to buy support. But let's find out. So I don't mind seeing the market falling. I just want to see, like, does this level offer some support? Does this August 5th bottom offer something that the market's interested in? Something like that. So I'm just trying to make some sense of it technically. If we're getting a top right now, right? If this is going to be a near-term top, does this market spend time pulling back into election levels. Okay. Does it offer up a dead cat bounce and another flush lower? Does it use the 200 moving average in any capacity for a buying opportunity, or maybe gets a little bit uglier? Maybe we have that fake out trade where the 50 period crosses the 200 period and everyone's like the death cross, and then the market rips all the way back up here and then tries to grind higher, and that's actually your buy zone and it's a fake out signal, right? So there's all sorts of ways to look at these markets and predict some type of, it can go up, it could go down, it could go sideways. Nobody really knows, but you trade it. Okay. All right, let's see what we have going on here. So where am I at for the rest of the day? Nearing the lows, nearing the lows. Okay, here is the Dow. A nice little losing streak in the Dow. We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 red candles in a row. Today's actually up slightly. Still a red candle, but up slightly. But that is 11 red candles in a row. We're back down to the 100 moving average. We have basically come all the way back into the election gap. Now, is that enough to say, hey, the Dow's going to start recovering? I'm not calling the bottom there. I mean, I hope it's easier to say that the Dow can either have like a short-term recovery and then another flush lower to finish out a 1, 2, 3 correction. Look at my 200, look at my structure, look at my August 5th lows. But from that high to that low, I mean, just give me some opportunities to buy low. I'll even get like somewhat like wide and flexible on my areas. If I get a 200 moving average and I start establishing option positions and take this all the way down to the August 5th bottom, look, if I just say, okay, 200 moving average gets hit, I'm going to throw in some option trades over like a 60-day window. If the August 5th low gets hit, I'm going to throw in some option trades over a 60-day window. Now, I don't have to go shorter than that. I can also go longer than that. I can say, look, I'll give myself 3 to 6 months to be right and see if we get back to these highs. It's at least a discount to get some income. Okay. So I don't know. That's pretty much a simple way to look at it. And that way I'm not in a hurry, or I'm not forcing trades. The one thing I'll say that I'll be watching tomorrow, Russell, same type of thing. We've pulled back aggressively on the Russell. And, I got to wonder on this one. It's like small caps do make me a little bit nervous. I think there's some good structure in here to offer some support. Okay. But if we have higher yields and higher borrowing costs and, business is getting more expensive, small caps are not going to perform super well. I guess my biggest concern technically on the Russell would be that this high actually comes all the way back to this low. And so even dynamically, I'd like to say like, yeah, I want to be in the Russell. Well, if it doesn't bounce at the 200 moving average, I don't really want to be in the Russell. Because if we come back in and find this level, well, there's maybe a bounce offered there. But if we come all the way back down, if I'm going to wait, I'm just going to buy the Russell at 170. And that's a big, big, big drop. If the market's going to give it all back, I mean, look at this high to low. That would be a 30+% correction in small caps. Is it possible? Yeah, sure. Is it going to find the 200 and bounce? Maybe. But anyway, let me see what the IWM is sitting at. Like right now, if I did a 1-1-1 position on the IWM or ratio spread even, if I go out, let's go out 90 days. And I guess the question is, how low can I go in the option chain? So if I said, all right, you know what? I'm willing to take some ownership at 200 on the Russell. Okay. Let me see how low I can get that. So if I were to buy a 200 and sell a 195 and then sell a 190. Like, okay, so what can I do here? I can get a profit trap where I'm willing to take the shares at 190, which is what's our discount there? If we go from high to low all the way down to 190, the Russell could drop 22% from high to low, and I would take some ownership. I would only be at that point, I would be about 10 to 11% off the lows, which would have gotten us back into 2022. A COVID low would be extremely scary on small caps. And the question is like, do I really want to trade the Russell 2000, or do I want to try to, find a more of a sector, more of a niche, if you will, like top 200 growth, top 200 value, like something that gives me a little bit better concentration to quality Russell as opposed to broad Russell, But I mean, it's not a bad income trade. I am wondering, let me just delete that for a second. If I went even wider, I'll do a 165 by 160 and do that for 2 on the 160. I mean, I can get 72 cents of income for a trade that is likely going to have zero assignment. There's only a 5% chance of assignment here, 4% chance of assignment, which gives me about a 95, 96% chance of profit. I'm pretty sure right now with the IWM at IV rank of 54, it's not going to get too much worse than that. But the nice thing is if I can trap this thing, let's say that I did a 200 by 195, and then I do a 165. So I can still get credit on that trade. I have a $5 income trade with a bear trap. I'm just not excited about making 25 bucks. Now, that being said, I could probably do something in Russell futures, which is okay, but let's find out. Let's go Russell. RTY is E-minis. And if I went out to March, 91 days out, how can I build this trade? So let's take a look at RTY feed right here. Let's find some structure, that level, and that level. And so I would say this 16, I'll just go 1670, 1675. So 1600. Let me see if this, like if it did 19 by 18. Not worth it. This trade here, $180 income. So this one's not awful. I'm not taking assignment of the contract. I probably have to hedge this out a little bit, but I'm only making 190 bucks. I'd want to hedge that in some capacity. So a 380 credit. How cheap could I get that? So now my buying power is way lower. My max risk is quite a bit lower. Maybe I sacrifice there. I make 145 bucks on the trade. Not my favorite. I don't know. Anyway, I'm just looking at ideas. Look, we're pulling back. I mean, if we have a Russell trade that does this, high, low, lower, high, lower, low, there's a good spot to be looking at long around 2000. And rather than getting long here, I probably just look at ratio spreads or out of the money bull put spreads or something on futures where I have an income trade that if the market comes down in like an orderly fashion, then there's ways to make a lot of money there without ever taking any assignment. And I put on a trade that'd be like a bear trap. So if price goes down, I have a profit trap by the bears, and then I have an assignment level that is also hedged. So if price is going lower, I can put a stop loss on this trade. I can hedge it out so this one has profit. It would be 4 legs in total, but there's a way to do that where the income expected should be high probability. The hedge could be worthless. The bear trap could be something that pays me kind of the double whammy. I don't know. It's a lot to trade. I don't love doing it in futures because if we do have a volatility event, it can get a little gnarly out there in futures land. So I'd almost rather trade this on like index or ETF instead of futures. Although futures it pays really well. You just got to have it hedged. You don't want to be like overexposed. You don't want ownership on futures products. Okay. All right. Anyway, let's go on DXY. Hey, what do you know? The dollar made new highs. What did I say was going to happen? Probably going to find support at 105.50, and it did. We are now making higher highs in the dollar. Look, I could still, even if we have a pullback on the dollar, this is not a sell opportunity in my opinion. I think this dollar, until proven otherwise, this dollar is still pretty darn well supported. So, if we do something like this in the currencies where we pull back a little bit, I still think this is an accumulation area for the dollar, and there's more upside potential when the trend goes. The tricky part about the dollar is maybe we don't even have a pullback, right? This was our trap. This was the big liquidity flow on the dollar. It ripped through all these levels. It swept these previous highs. And what are we watching? Well, if this thing keeps going and going and going like Energizer Bunny style, I don't know if we're going all the way up here. If I'm going to short the dollar, it better be at such a ridiculous level that's so overextended that it just looks like I can't not take the trade. And what does that look like on Aussie dollar or New Zealand dollar or Euro dollar or anything with the dollar cross? It probably just looks like, holy crap, I can't believe the trend did that for so long. And now I'm just going to have to start, taking little trades and dollar cost averaging with these crazy overbought conditions or oversold conditions. So speaking of dollar, where's my dollar Swiss? Dollar Swiss somehow had a pullback today. Well, that's annoying. Dollar CAD somehow had a pullback today. What the heck, dude? Dollar index is up. Does that mean euro dollar's down? Is that why this is lower? Yeah, I guess. So euro dollar is down. Dollar index is up. The Aussie dollar dropped today? Nope. I mean, I'm almost break even on my Aussie dollar. New Zealand dollar, I'm upside down a little bit on that one on 2 entries. 1, 2. I haven't been filled on the third one yet. I'm getting close. So I should be able to move that break even down a little bit lower if my NZD USD gets filled. All right. Dollar Swiss still looking to get up to my 9,200 target, and dollar CAD still looking to get up to my 44.50. 44.50 to, oh man, it was really freaking close. If I didn't adjust my take profit yesterday, that would have hit this the take profit yesterday. I had it set to 44.50 and we went up to 44.66. So I guess I got a little greedy on the take profit, but I'm going to keep it right there. I still think we can go higher. So I'll keep an eye on it. Oil continues to be like one of the trickiest, choppiest, nastiest assets right now. It's still very difficult to see what this is going to do. Inflation looks even worse if we have oil going higher. Inflation is relatively contained from the energy side if it stays sideways. And maybe there's some improvements in inflation if you have transportation, fuel, oil, gas, things like that coming down if oil breaks the low at 67. So I think greater than 72 is more inflation / energy prices going higher. That could be a little run against the dollar as well. Sideways seems to be everything going on right now, and it's been that way for months. I mean, we've been sideways since October. So we've been sideways for almost 3 months. And it's a tight range. I mean, from 67 to like 71, that's a tight range on oil. Oil futures, I got to this trade. This trade's done. I closed it out for a small win. I'm glad that I did. Not going to worry about it anymore. Nat gas, making new highs. I'm not doing anything with this trade. I was hoping I could get filled at a discount. Gold, probably still coming back into a high, low, lower, high, lower, low situation. I'd read like gold might be a concern as far as, the U.S. trying to hold Bitcoin reserve and going anti-gold. It's like, that doesn't make any sense because like there's no gold standard in the U.S. anyway. Once we did the Bretton Woods thing, we went off the gold standard. Gold doesn't matter to the U.S. Is our central bank actively buying gold? Not like China. So I don't know. I don't think that's why it plays into it. I think, getting to a more sound technical level, finding some really good structure back here, previous resistance becoming support, finding some trend line support. I think 2,400 is a great spot to be looking to go long gold. So I hope we get there. I will probably end up doing some credit spreads, debit spreads, and dollar cost averaging into that 25 to 2,400 zone. And I will be probably longer term. More than likely going like 6 to 12 months out on gold, maybe longer, but just an income trade trying to get to higher highs. Aussie dollar take profit New Zealand dollar I know is like 60.50. New Zealand dollar 60.50 is my take profit in New Zealand dollar, and then Aussie dollar I'm just going to try to get back to break even around 6,400 because I took that first entry at 64. So if I get entry 1, entry 2, entry 3, there's my break even. Okay. Actually, no, my first entry was 6,300. So 6,300, and then I'm in pending buy at 6,200. So yeah, I've got trades 1 and 2. There's my break even. If we come back up into a positive gain right there, I'll probably take profit. So I'm going to set a chart alarm around 63.20, 0.6320. And that, what the heck? 0.6320. There we go. And this would be a daily pocket fill. So if we have a daily pocket fill, which is just above that, around 63.30, if I have my entry 1 and entry 2, and this gets back into profit, I'll take a small win on entry 1 and a nice win on entry 2. Be happy, I'll walk away, and I won't worry about the Aussie dollar anymore. If it comes down lower, I'm going to buy some more at 60.20. I don't have a stop loss in the Aussie dollar. These are all small trades. I'm going to manage this with a drawdown where the percent and the dollars are manageable. I'm just going to test some levels first and then wait and see how the dollar move is behaving. But going back to 6,000, why would I take that level? Because we had that COVID crash low in there. That essentially was a flash crash low. So we got all the way down to like 55. Is this market interested in trying to go to 55 again? I don't know. I hope it's not. But if it does, I'll be willing to kind of ride it down there and figure out where I'm going to manage my risk. You mentioned SCHD this morning because of the split. How are you trading it? I just dollar cost average into it, Kyle. SCHD. So we did the split right here. That was a 3-to-1 split. So this was a $70, $80 ETF. Now it's in the 20s. If you look at the holdings for SCHD, I think there's over 100 companies here. Let's go holdings list. So we have 103 companies in SCHD. The market weighting it's pretty heavy, towards like big names in the markets, right? BlackRock, Cisco, Bristol Myers, Home Depot, Chevron, Verizon, Pfizer, Altria. Like the average dividend here is around like 4%. If I just look at the stock here, yeah, 3.67%, and it's also been appreciating. It's like 2023 to now. It's been up a ton. It's like, so you get some appreciation in price that's up 33% in the last year. In addition to that, you've also had a dividend to go with it as a kicker. Now, yes, we've given back some pretty healthy gains. That's 33% up, and then we've dropped a little bit. So your net gain since the bottom is around 22%. But 22% with a nearly 4% kicker, it's like, okay, it's okay, and it's not as volatile as anything that's growth related. Now the difference is like growth related, like SCHG. This one has like almost no pullback, and you go to October of 2023 right here. It's like this thing's probably well up over 30%. It's up 66%, but there is potentially like more downside correction. Take this low, take this high, look at a retracement area. Probably something like that. Do we find the 200 moving average? Do we find the August 5th bottoms? And that's kind of becoming my new level. If I'm going to really get some fantastic levels in buying things or adding positions, it's going to be the daily 200 EMA down to the August 5th bottom. And I'll start creating some option trades in that area to basically like brace for some downward movement and look for some bouncing and look for some upward bottoming. And I mean, if I'm right, I'm right. If I'm wrong, I'll trade to find risk. But I do think that's a healthy area to get like a nice big correction. Let's say that SCHG, which is growth, let's say this one goes, down to the 200. That's a 13, almost 14% sell-off. We find the August 5th bottom. That's a 22, almost 23% sell-off. So look, I'd establish some positions with a 13% discount, more positions at a 23% discount. I win or I lose. I mean, this like everything else is designed to go up. I mean, it's not the SPY, it's not the Qs, but there's a decent amount of diversification here with stocks over the board, all sorts of different sectors, that it should be diversified enough that we're not looking at being super concentrated. But if you go to SCHG holdings, it's a lot like a lot of other things. It's going to be most likely Mag 7. There's 11% of this is in Apple, 9.47 in Microsoft, 9% in Nvidia, 6% in Amazon. It's like you are trading the Mag 7 with SCHG. So what does that mean? Well, it's still diversified because there's like 230 companies in this, but those 230 companies are tiny slivers of diversification when you have, I mean, look at the top 10 holdings. Okay, just add the number. There's probably like 30+% of this is in the top 10 stocks. 10.81, 9.47, 8.99, 6.05, 4.88, 4.10, 3.8, 3.21, 2.65, 2.25. Holy crap. That can't be right. Is that right? Did I fat finger a number? That is insane. I'll do a rough math. So here's 20, 30, 36, 40. Oh my God, that's right. So 56% of SCHG is literally top 10 stocks, which is mostly Mag 7. Whew, that's high concentration. I mean, look, if the Mag 7 disappoints this market in any way, shape, or form, we are going to drop. Because clearly the broader market is underperforming. The Mag 7's holding us up right now, and it's a strong foundation, yes, but man, it is so concentrated, it is scary. If it just shows any cracks or shows like, you know what, Mag 7's not growing enough, it's not rotating enough, it's not if the multipliers aren't good enough or the multiples aren't good enough, it just doesn't take a lot for this market to be like, it's too high, it's overvalued, we got to correct, we got to find reversions, and Mag 7 goes down, brings the whole market with it. So it really is like, if there's a crack in the giant dam of trading, Mag 7 is that dam. And if there's a leak if there's a water leak, I don't know where it's coming from. It could be coming from Tesla. It could be coming from Netflix or Nvidia. Why? Because like Nvidia's been down, semiconductors are being questioned. The capex spending is being questioned. Tesla's going to be highly volatile, like it was the last couple of days. Meta needs to have a bar count retracement, I think. So crazy, right? That's like scary how heavily weighted that is. Now that's also why, and I say that, but it's like that's why SCHG has been performing so well. If you take a look at just the last little bit of history here, I mean SCHG, which also has a tiny little dividend, nothing to get excited about, but 0.4%, it's better than nothing. But for the last 5 years, this thing's up 145% the last 5 years. If you go to Mags, okay, and you look at the 5-year performance, it's up 125.9. So if you traded just the Mag 7, 5-year run is 125. If you traded SCHG for Schwab Growth, you're up 145%. Might not seem like a lot, but that's another 20% over 5 years. It's not bad. It's an extra 4% to your portfolio. Covers some tax burden, right? Adds to the bottom line. So anyway, pretty wild stuff. Just crazy concentrated. That's really all it is. So I know that's a little tangent there, Kyle, but does that make sense on SCHD? What am I doing to it? I'm adding positions. So SCHD, I'm just going to dollar cost average. So I already bought some. I took a small chunk, and here's my overall exposure. So SCHD, NVIDIA is at 130. Am I going to get a sweet spot on NVIDIA this week? I might get really lucky above 130. If it stays above 130 tomorrow, I'm getting if it stays like right at 130, I'm getting like, I don't know, $450 a contract. I kind of want the shares, to be honest. It's like I want the shares, but we'll see. Anyway, I digress. SCHG and D. So I bought shares around 28.45. So I'm down about $1.50 right now. SCHG, I bought some shares at 26 and change. I'm actually up some profit on that one. So right now, growth and dividend, it's a wash. I'm down on dividend. I'm up on growth. It's a wash. Am I going to do anything? Nope. I'm just going to wait. So if growth offers me a pullback, I'll probably buy some pullbacks. If dividends offer me, I mean, this isn't a bad spot, but if we have, and like I keep saying this technically, high, low, lower high, lower low. I mean, think about this with equal lows and a high. If we just come back and have some type of balance in here, I'd be pretty happy to scoop up some more around like $26. Now, why am I not getting super excited about this? Because I just put in, $2,800 at $28. For me to put in another 100 shares and spend another $2,600 at $2 less, it's like, probably not, right? All I'm going to do is like, I bought it here. I'm going to wait. And if it comes like crashing down, then sure, I'll get in at like $23 or $22. And because we're talking about this instrument going all the way back down to like, 2022 bottoms, 2023, 2024 bottoms. So I'll just stay here and collect my 4% and see if there's some resiliency in the dividend play and some of the bigger blue chips that are cash heavy, that don't have a lot of debt, that have a good competitive advantage. Are they going to make all-time highs? I don't know. But I just think for this stock to be, 28 down to 23, I can stomach whatever drawdown that is. So I'm just going to use shares. I'm not going to trade a lot of options on it right now. I'm just going to use shares. Okay. What are your thoughts on tops and bottoms being formed in October, December, January, and Forex? Um, October, hardly ever. I think December, January is a possibility. Um, again, this is just my opinion, but December, January, maybe, because we have like end of year flows and maybe it's beginning of the year. So yeah, I could see tops and bottoms in January, December, January for like end of year, beginning of year. The rest of it, honestly, like August, September are usually like the tops and bottoms that I see in the market. These pre-market moves that tend to happen like January, February is a bit of a chop fest, and then we get into some trend. We establish a pre-summer push like March, April, May. A lot of times these pre-summer pushes, okay, a lot of times these pre-summer pushes will extend into May, June, July, drift into August. You get a little bit of August volatility, a little bit of August, September top or bottom, and then we come out swinging like September, October. Usually, I mean, I don't see a lot of tops and bottoms in October. Usually, I think it depends on the currency pair or it depends on the instrument. But it generally is it's a Q4 catalyst. So it's like if the market's going to trend October, November, December, which is pretty common in most markets, but Forex too. Like we get some trends in the end of the year. October, but that was an equities bottom, Sarah, right? Like equities bottomed in 2022 and bottomed in 2023. But I mean, give me a Forex pair that topped or bottomed in October, outside of being like it's a risk on, risk off trade. Because if it's risk on, risk off, then it's the exact sentiment as the stock market, right? So if you're trading like Aussie yen and the stock market bottoms out, you're going to see a bottom in the Aussie yen, right? Aussie dollar, New Zealand dollar. Um, like if it's risk on, risk off, and it correlates with the stock market. I mean, October 22 was a bottom in the stock market. October 2023 was a bottom in the stock market. But the currency pairs that would be correlated, sure, there's a risk on, risk off correlation. But just a typical currency pair, I don't see a lot of tops and bottoms in October. I think more like December, January, beginning, end of the year, or possibly like in August, September as we come out of the summer. Yeah, those are risk on, risk off. That's my point. So those were more tied to the dollar flows and the risk on, risk off trading of the equities market. Because look, the dollar's been like a major catalyst the last couple of years. Yeah. So all right. Anyway, Kyle, you get an SEHD? Yep, you're good. Okay, cool. All right, so I'm good there. Let's go back to oil, gold, silver. We did oil, we did gold. Let's have a look at Bitcoin. Bitcoin's at 96. Pretty healthy pullback on Bitcoin, which is totally fine. I had talked about this, necessary correction based on symmetry. I didn't short it. I'm just waiting to see what happens. I would gladly put on some more trades if we come back into 90 and 80K. So anywhere between 90K and 80K, I'm going to start using some. Probably I'll dollar cost average into my Coinbase itself. I will probably look at a trade on IBIT, FBTC. I think I looked at a BTC, which is a grayscale mini. There's not a lot of price history on that one, but the expense ratio is better. I might I don't know. It's like I think if I just buy it, I buy it. So I don't know if I added this into my watch list or not. Let me add this in. So this is grayscale. This one. So Grayscale Bitcoin Mini Trust. I'm going to add this in and then drag this up to my other BTC assets. So here, there we go. So BITO, IBIT, FBTC, I'll put it right here before I get into the stocks. So this one doesn't have really a price history, which is what I don't love about it. I don't know, that was a 1-to-5 split. So I don't know. It's like, do I really want to trade this? I mean, if I look at a chart, it's a little deceiving. I think I'll just stick to BITO. Actually, I'd rather stick to IBIT, to be honest. BITO, I'm actually very happy that when we hit this fresh high, I closed out my call option. This trade closed out for a $13 credit. So that was a nice return there. The other ones are all naked puts, which are way out of the money at this point. So that's more income coming in by the end of the year. EETH, that's a big drop in EETH. I need it to stay above $60 like this week and next week and into January. Hopefully it does. Copper dropped all the way back down to recent lows. FBTC. Can we trade options yet on FBTC? FBTC. Yep, we can trade options on IBIT and FBTC now, so that's good. So your Fidelity Bitcoin and your BlackRock Bitcoin, you can trade options on, which is nice. MicroStrategy 327. I did take a small position this week at 372.50. I got filled in that for dollar cost average. My next position is this is trade 1. This is trade 2. The rest of them are all a bunch of puts and ratio spreads below 200. So high, low, lower high, lower low. If we hit symmetry on MicroStrategy, that should be some buying opportunities around 240. I'm going to set a chart alarm at 250. 250, and I'll say approaching symmetry and look for adding OTM trades. So out of the money trades, probably ratio spreads, probably 1-1-1s, look for some income opportunities. If I take any assignment, I'm okay with that, but it's going to be at a much lower price. But I want to see what this IV looks like, and implied volatility on MSTR right now is trading at 50. So it's okay. But if we come down a little bit lower, we're at the 50 period moving average right now. I still think there's symmetry to be hit, and that's around WBD. Are you freaking kidding me, dude? Right before closing bell. All right. The trade. I mean, trade's done, but I'm just curious. WBD. It's trading for the same thing. So we're at the money, and this has to open and basically drop 50 cents for that to be worth anything. So it doesn't matter. I closed out a trade this morning for a small loss. It was like a 19-cent debit. I closed it out for 9 cents. I saved half the risk on it. But I was just curious because, like, if it was going to go all the way down to my $10 liquidity level that I've been eyeing for the last 2 weeks, that actually would be a trade that's paying 50 cents on a 19-cent debit, which would end up being a nice win. But whatever. I closed out, saved the loss. Okay, so let's see. Tomorrow is Friday. Tomorrow's quadruple witching. Tomorrow's PCE in the morning, 8:30 a.m. We'll see what the news gives us. There is likely going to be some volatility. I am as curious as everyone else. Nice little futures trade up $1,700. I'm going to close that out. Please, thank you. 1,700 bucks. Thank you. Okay, I let that ride all morning. We had a break retest. I shorted that breakout or that retest, shorted the retest, and off we went. I was trying to take it right back down to the previous lows, and we were very close to getting there end of day. What did my SPX trade end up doing? I know I closed out for profit earlier, but I'm pretty sure it would have been a full winner. I'm going to move this workspace out of the way. SPX at 58.67. I think my strike was 58.50. So that 55 cents I took on my daily profit play would have been full profit today. I'm glad I didn't hang on to it. I mean, it's fine. But it was 2 for 2 on the day, 7 for 7 on the week on daily profit play. That's good. We'll have another crack at it tomorrow. Tomorrow, quadruple witching. I do want to assess. Hopefully, we don't get a lot of noise in the morning. I might just kind of sit it out and wait if I could catch a trade by, middle morning. I don't know. We're going to have another new group of traders coming in. I'll probably spend at least the first 30 minutes talking education, and then let's assess just the first few minutes of trading. So, all right. Before you go today, would you kindly hit the thumbs up button for me? If you're not a part of my channel, kindly subscribe. I will give you my Telegram channel if you'd like to join. Anything for just free Telegram updates. Yes, there's going to be some webinar stuff, and there's some marketing material because it's one for everybody. So I've got 1,300 followers on my Telegram. I've got about 800 followers on Discord. So Discord is a place that I put all my content. I'll share both links. I'll post that in the chat. So here is Chris Pulver Telegram to join if you're interested in joining. So Chris Pulver Telegram and Chris Pulver Trading Discord. Post that link as well. And just a quick disclaimer on Discord, if you join my channel, I don't send friend requests. I don't send you or initiate direct messages. So if you see that, please help me, keep the community safe. Just report that stuff, flag it, ban them, kick them, whatever you can. There's a lot of scammers that hide out in direct messages, and they try to establish these conversations, and they send your friend requests, and you think it's for me. It's not. Okay, just get into my channel, and it's public for everybody, free group chat, FOREX charts, in stocks and options and futures and just all my content from all my classrooms, all my services, all my membership stuff. It's just one, it's all my content in one place. That's why I built the Discord channel. I don't want sub threads. I don't want all these breakout channels. I don't want it to be this Discord that's impossible to manage. So it's pretty basic, but I'm just trying to keep it very clean and very simple. All right. So let me go invite. This will be good for just a couple of days. And there it is. Okay. And you can jump into Telegram. You can jump into Discord. And I'll be back at it tomorrow. Pound pairs with a pound Aussie. I don't know. I don't like the pound much. Pound Aussie. I mean, the stupid part about the pound Aussie is we didn't acknowledge this resistance at all. And this is what is scary about the volatility of a currency pair like that. This thing went from 2,000 to 2.03. It's like that's a 300 pip rush and flood through that top. And now it's coming back like, oh, that was the top. Like that is complete manipulation at these tops. That is a sweep of that high. But when you get currency pairs that sweep by like 200 to 300 pips, it's really scary. You know, here's my trade. If this thing comes all the way back down, okay, to this level, could I see a topping pattern on that on like a 4-hour time frame? Maybe. Like, let me look at a 4-hour swing. So like right here, if my pound Aussie comes back down to this level here and takes out that low, then I'd like a swing trade, stop loss below, look at a swing, and we just trade it back down to where it started. Like, I mean, a lot of these currency pairs they'll find ranges, but I mean, we have seen some equal lows, some higher lows. This resistance level I thought was a pretty safe one, and it just blew through it. But if we end up topping out, and it's just another sweep back to the downside. So trade to watch for, but it's crazy to think like you gotta somehow be super flexible on your stop losses and take 200, 300, 400 pips of heat in order to get proven right on a trade. It's like that's why I just like options more. You know, I mean, honestly, like I've traded currency pairs since 2007. And over the last, 5-6 years, I'm just like, I invest in currencies. I trade big areas with really small trade sizes, and I will get aggressive when I believe that I've got a good trade. Other than that, I'm just doing a lot of testing, looking at super obvious levels. And I just trade so small because the market does crap like this all the time, right? The market runs these highs and sweeps these highs and it's hundreds and hundreds of pips. Why is that? Because there's liquidity sitting right there and everyone that's got stop losses gets ran out and then they get reversed. And it's games like that I'm like, it's exhausting. It's so difficult to trade it that way and let alone teach people how to basically trade smaller and never use stop losses. It's pretty much impossible to teach traders to do that successfully because traders don't want to trade small. Traders care too much about like I need to make money today. I need to make money right now. And it's like, man, I'm telling you, you can make money in these markets if you just give yourself some time. I mean, if there's a currency trade that takes me 1 to 3 months, I'll probably make money. If there's a currency trade that gives me 6 to 12 months, I'll probably make money. But when I have to find a way to like get pips today or get pips this week, it's like, why? I don't have to. It's like, would you rather be right or would you rather have to grind? You know, like I don't mind stomaching a single digit drawdown like 1-2% in order for me to average into a trade that ends up paying me 4, 5, 6, 7, 8% to the upside. But I can test all those levels and I don't have price really go too far against me. My drawdowns are completely manageable. And then I can build my way through a trade where it's like, maybe I take a 500 pip, area. It's like, okay, well, I'll take on some heat if I'm wrong, but I'm only getting into like one position of many. So I don't know. That's just my style of trading, but it's worked for me for a lot of years to be consistent in Forex. It's helped me be a much better trader. It's just hard. It's hard to teach that way because nobody has the patience. So easiest thing for me to teach is trade options. You can trade risk defined. You can be as stupid as you want. You can be dead wrong in direction. You can still find a way to make money. So a little bit easier to trade it. Certainly a lot easier to teach it when it's like you understand define risk. Just makes trading a lot easier. Okay. So would it be risk on? I mean, in a way, yes, but like Aussie and pound are both risk on, risk off, or risk on currency pairs. So what this would be to me is, the pound dollars is hitting fresh lows, the euro dollar is hitting fresh lows, the Aussie dollar is coming back down. I mean, didn't we have a BOE today? Did we have Bank of England today? We did, and they held rates, but they had a descent in the bank rate, the bank votes. So from 0.27 to 0.36, I don't really know what that means. Are they going to look to cut again in 2025? I have no idea. I mean, it doesn't really matter. Like pound pairs, pound is also like a petro trade. So I mean, if you got oil dropping or looking beat up, like the pound's vulnerable. So same with the CAD. Aussie, in my opinion, is like it's a proxy for the dollar right now. If it's dollar strength, expect some Aussie weakness. It's also a proxy for China. If China is showing some resiliency, which is another big if, China right now is just kind of hanging out. Now, I'll say this. I'll make a kind of a bold projection here. There is a possibility that China could still be setting up for a buy opportunity coming into Q1 of next year. Okay. I mean, I look at it as we won't really have a bunch of stimulus announcements until March of 2025. But the market got all excited here. Okay. So we have this low, we have this high, we have this market rebalancing in here, finding some nice equilibrium. To me, this is an opportunity to look for another long to see if China can make a recovery. If I'm looking for good opportunity in 2025, I know nobody likes to trade China. Very few traders, that I talk about. I mean, look, traders that follow my services, we've got investments in Alibaba, Baidu, and JD and some other. It's a lot of option stuff. But it is such a hated I mean, it's number one, it's non-US. So it's already foreign. Number two, it's like nobody trusts it because like, oh, you can't trust the books. Okay, fine. But they're ADRs. They're American depository receipts. They are the ability for Western money to trade Chinese stocks. That's good. That's good flow for a Chinese company that would really basically be if it was internal only and it was a domestic market, I would not trade any of it. But because it's a global company, I'm hoping that Alibaba and Baidu is essentially like your Google and Amazon of China. And if it is, it should survive, right? If JD is like your best ecom that the US has to offer, okay, fine. KWeb is large cap tech. FXI is I think just a large cap ETF. Hence saying index is HSI. From a technical side, I think there is a lot of potential on all these stocks. If this is a swing, this is a correction, call it an A. If I can draw it that way, there's an A, there's a B. If this is a C and this is a bullish pattern, I'll make a projection. I'm going to trade defined risk on China and see if this goes up to a D. If we get back to the same high again, that's still a lot of money. If we get to a symmetry level, that's even more money. So I'm just going to watch because I think there is a buying opportunity in here, and I'm going to trade it. So Alibaba, obviously it's a little bit nastier, but look at your swing. This low, this high, if this is building some type of ugly structure, I don't know what it's going to be, but maybe it's this. Maybe it's some ugly structure. Maybe it comes back down to these lows again, but to me, it's a buying opportunity to get long and take it back up to September highs. I'll trade it. It's like what stock right now in the US can I look at and think that there's a good opportunity? Nothing. They all got to pull back, because if I look at a US stock that's been down 70, 80% for the last year or two, I'm not touching that thing. To me, that's dead capital. But China's just like this underrated, beat up. Nobody wants to touch it. Nobody will invest in it. So I think it's a bit of an opportunity. And, September was a good example. I made some good profits in September because of that. And then I, kept some exposure into it. I concentrated it a little bit, but we'll see what happens. So anyway, another thing to watch for 2025, one of many. All right, everybody, happy Thursday. I'll let you go. We'll be back tomorrow. Okay. Thanks. Subscribe to the channel, join the Telegram Discord, and I'll see you soon. Thanks. Bye.